And we must be streaming live. Is that right?
We are live.
All right. Welcome out to our halftime report. I grabbed a cup of coffee. I guess, isn't that video supposed to be 28 seconds, Matt? I thought I had a timer right there, but that's all right. Welcome out, guys.
It's close. It's close to 28 seconds.
Ding, 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 ding. All right. We've got Coach Noah, Coach Matt, and our host, Cody, here, ready for our halftime report. It's Fed Day, FOMC meeting today, Matt. You know, what do they meet? 8 times a year, I believe.
Every 6 weeks.
Yeah, every 6 weeks or so. We know they're going to raise rates. It would be a complete shock to the entire market if they did not raise rates here today. There's a very, very slim chance, like 4 or 5% maybe, that they go up 50 basis points. I don't believe it's going to happen.
Not going to happen.
What do we need to pay attention to here today?
Well, obviously it's Fed Day, and Fed Day gets a lot of, news and a lot of hoopla and a lot of eyes watching on it. But the one thing I will suggest, and we'll get into kind of the market and what we do every single day here in just 1 second. But the one thing I'll suggest about Fed Day is it's got a lot of noise around it, right? We talked about this quite a bit yesterday, but it's got a lot of noise around it. But the simple reality is that noise doesn't come to fruition with a lot of price movement, right? And I want to talk about something very quickly. If you look at the S&P 500 and you're analyzing the S&P 500, Noah, thank you for sharing your screen there. The S&P 500 right now has an ATR of about 18 points, which based on the average price movement, and that's from the high to the low. But the average price movement right now is about 0.6% every single day that the market will move. Whether that's, and again, that's not open to close, but that is, from the high of the day to the low of the day, averaged out over the last 14 days. So it moves a slightly more than 0.5% a day. Tim, over the since 1995, okay, since 1995, and we've had, hundreds of announcements since then, okay? I'm going to give you an over-under. The over-under is 0.5%. On Fed Day, do you average more than 0.5% movement on Fed Day over the last 23 years?
It's got to be more, right?
You think it's got to be more, right?
I mean, I remember. Now, here's the problem. I remember when I started trading, I know it was more. I remember those days. Or maybe that's just my perception of being a new trader and seeing the volatility sometimes.
Or maybe it was the fact that we were trading in 06, 07 and the right trade environment.
But then I also know it was less there for a long time. I mean, it's been a dud, kind of firecracker dud. You got the fuse lit and it's coming all the way down, 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 and just nothing,
Okay. So you're going to say over 0.5. The market.
I'm going to say over 0.5%. I'm going to say over.
Okay. And the market right now is moving about 0.6%. Noah Davidson, why don't you come on in here for a second?
I am here.
Okay. Noah, over under 0.5% over the last 23 years. On Fed Day, does the market move more than 0.5%?
I'm going to say over just because why not? Okay.
When the average over the last 23 years is 0.32% is the average. 0.32%. When they hike, it's 0.29%. When they hold, it's 0.31%. When they when they cut rates, it's 0.44%. Even when the Fed cuts rates, guys, it doesn't average over 0.5%. Think about that number.
Yeah, it's kind of like
cherry picking data to get the results you want, Matt.
I just picked 1995, and I'm not even going to pick it because I'm going to give MarketWatch a shout out. MarketWatch picked it. I read the article over there at MarketWatch, but I was a little surprised by that too because I was excited. Tim, I'm with you. I remember those days in 06, 07, 08. When the markets were extremely volatile. I remember those days in 2009 when they announced quantitative easing, and I remember those days when they cut it, and I remember those days when they announced quantitative easing infinity, and I remember those days when they started decoupling that quantitative easing infinity, and we remember those days, but those days are very few. Guys, there was a 9-year stretch between 2009, well, not a 9, but about an 8-year stretch where they didn't do anything with interest rates. Literally not a thing. They left them at zero for ever and ever and ever. So yeah, I mean, we remember those times of volatile conditions, but for the most part, the market just turns. That's all it does.
It's interesting though. It's kind of like the Nike earnings. One of the reasons why we didn't want to play the Nike earnings in front of earnings is because we had the one gap that was out of range, Matt. And so I think and maybe it's scars, maybe it's not actually logical, it's my emotion. I just have these moments and memories of Fed Day turning into something crazy, and it's not happened in a long time like you're talking about. It's not very common, and we're probably overpricing the risk. But there is still risk there.
I agree. No, go ahead.
Doesn't the whole market overprice risk? And don't we see a little spike in implied volatility estimates right as the Feds are speaking? And overall, the market, braces for it. My first experience with the Fed, and actually how I learned about how the Fed really influences the market, was the day Greenspan said the words irrational exuberance. And all of a sudden, I learned who Alan Greenspan was because every one of my stop losses got hit that day. And the market did move a lot. So to me, that's my initial bias with the Fed, is that it makes the market move, even though statistically you've proven otherwise. I'm holding on to that in my head.
And I'm with you guys on that. I'm not saying let's not price in risk. Let's not equate to risk here, because I remember those days. I wasn't trading when Greenspan said irrational exuberance, but I remember Bernanke. Right. I remember quantitative easing. I remember those days when the market just went crazy hot. And so, but for the most part, statistically, it just doesn't move. And especially with this Fed has been very consistent with what they've been telling us.
So here's a question. How much of that comes down to expectations being priced in? Like, what if they had a surprise, it moves more? If they do exactly what the expectation is, which what they do most of the time is they just do what's expected, no more, no less. Is it the expectation? If we have a surprise, something other than expectations that the market.
Well, and that's when the market gets spooked, right? I mean, the efficient market theory is basically states that everything known is embedded in price. We have known this interest rate hike of 0.25% for how long, guys? 6 months? I mean, at least 6 months. We've known that they were going to raise in September. We knew they weren't going to raise in August. We know they're not going to raise in November, and right now we believe they're going to raise in December. So, at this point, this is baked into the price of the market. It's baked into the bond market. There's a reason the bond market's going up to 3% on the 2 year, 10 years, because that is being baked into the price. It is like you said, Noah. It's those times when the Fed does something unexpectedly, like if they were to hold rates today. Okay, let's play the game. If they were to hold rates today, what would the market do?
Oh, if they did not raise rates and they held them, I think the market would sell, because then it's an indication they have some kind of perception of risk.
I think so too. And that's weird to think about, because you're thinking if they don't raise, they're going to keep it low. And then but then if you remember the 2015 market, when the good news was bad news and bad news was good news market. You guys remember that market?
Yep.
That's exactly what would happen here, Tim. I truly believe that if they did not raise, all of a sudden it's like, oh my God, good news now is bad news. Are they worried about the economy? The reason the market's been turning since 2017 is economy's been doing great. Economy's been doing great. Economy's been doing great. The Fed has said the economy is so good, we can justify these raises. But now if they don't raise, it's like, ooh, are you lying to us about something? Is there some inherent risk out there? I agree with you.
By the way, when Noah was talking about how he heard Alan Greenspan say irrational exuberance, I think that's what they call a humble brag. The kids would say, it's like, look at me. I've been trading for 25 years.
I've been doing this for way too long. But no, I didn't even know that's the thing, is I didn't even know who Alan Greenspan was. When that happened, all of a sudden the market just turned, and I was trying to figure out why it turned. And then, I was informed, oh, well, you're trading right before the Fed meeting. What are you thinking? It's like, oh, the Fed meeting. I didn't even know what that was. I went and looked it up. So,
here's a question I have for both of you. Very simple one. And Matt, I like where your thinking is heading here. What would have to happen? What would shock you, Matt? What do you expect, and what would shock you? What would surprise you?
Anything besides a quarter point hike would surprise me.
Even in the lingo, even if they kept a quarter but changed in language, who cares? It's all subtlety.
The language of Jerome Powell, we don't know yet. And we know what he said, but his language isn't the same way that we had with Janet Yellen. Under Janet Yellen, there was always a couple key phrases in that. And no, if you'll bring up your screen again, not your screen, that thing. there's these phrases, right? And this is from Morning Brew. It's a bingo game on the Fed you can play. Noah asked if we were going to play a drinking game later today, and I thought that would be funny as well. But there's certain words that are used in the Fed statement, and the Fed statement is not long, and everybody should read the Fed statement, every single Fed report. It's not long. It's like 600 words. It's like 4 paragraphs or something like that. Mm-hmm. But there's certain words that Janet Yellen would adjust. And if she said something, it was an indicator that, and this goes back to the good news is bad news. This is why I don't like Janet Yellen, because she's the one who kind of created the good news is bad news and bad news is good news type market conditions of 2014, 2015, and 2016. But you never knew what she wanted. And so we had to interpret that language as traders. And that was very frustrating. And that's why a lot of traders didn't like Janet Yellen, they liked them because they were basically creating a free market condition, but they didn't like the way they approached with their monetary policy statements. Jerome Powell, we don't have enough evidence yet. Remember, Bernanke was Fed chairman for what, 8 years? And Janet Yellen, was 2012, 6 years. Alan Greenspan, Noah, what was it, 86 to 04, 18 years?
There a long time, yeah.
Yeah. So Jerome Powell's only been on the job for, a day and a night, right? He's been on vacation. We don't know Jerome Powell yet. So I don't know if there's anything in the language I'm specifically looking at. Obviously, they're going to talk about 2% inflationary target. They're going to talk about, the economy's been doing very well, and that's how they're going to justify their continually interest rate hike. I don't see anything besides par for the course today, guys. I think they're going to raise a 1/4 point, and I'd be surprised anything else outside of that.
One thing I want you to do, Matt, go down to the SPX and actually look at the option chain, or Noah, I should say, while we're having this conversation. I want to take a look at the front week volatility. What is the market actually pricing in? It's interesting. We've talked about the VIX. We've talked about all these different indicators. You can actually measure what their expected move is on the SPX, waiting for some option data to come in here. And while that's coming up, Noah, is there anything that could happen today that would surprise you? What are you looking for?
I really don't expect any surprises. I think the Fed's role is just that of trying to not be a disruptor. So they use as much vanilla language as possible. Mm-hmm. And I would be shocked if they did have a very hawkish or dovish statement. I think that they're going to be pretty blasé on the language.
I think the one thing that would surprise me is if there's something in the statement that's interpreted that he's going after sovereignty from Trump. The Fed doesn't play politics. And I know Trump has been pounding his chest for months and months and months about how the Fed needs to do this and that and the other thing. And if they come out and explicitly say, hey, we are going to be doing this, this is our purpose. If they're really hawkish and they're going to raise rates, even in the face of what Trump has said lately, I think that would be very interesting to me. Front week volatility here, Matt, is only
a hawkish statement would be an attack against Trump.
Yeah,
it would.
The 0-day options right there, priced to expire here today, they only have an up or down 8-point move on the S&P.
Literally, they're not expecting movement here, guys.
Yeah.
And again, this. Oh, go ahead, Noel.
Oh, I was going to say, well, we're not expecting movement from the Fed announcement itself. My question or my thought is the market just waiting till the Fed is over to start buying and selling again? Like, ever just kind of playing wait and see. They're not really overly worried about what the Fed.
Well, the volume would suggest that so far today. Average volume on the ES contract is right around 1 million contracts. It's currently halfway through the market today, and we're about 40% there. So volume is slightly lower today than it is on average, and I think that will pick up. I do expect an increase in volume over the based on when the Fed announces. We do have 2 hours in the market after the Fed does make their announcement. And the one thing to keep in mind on this Fed announcement here, guys, is, and we've talked about this in the past, it's not just the announcement. It's not just the 1/4 point hike or the holding or the raising. It's not just that. You also have the Fed Q&A, you had the speeches, and then you have Jerome Powell speaking tomorrow. So this is not one of those economic events like an unemployment report where the market prices in the number and then everybody just moves on. This is an event, and that event takes not seconds, but hours.
Sure. And no, I'm sure there are institutions that have already dialed up what they want to do in advance of whatever the announcement is, and then whenever it comes, they use those events as volatility events to push volume in and out of the market. Noah, I'm going to send you a link in our chat here privately. I want you to click on his website. It's the FRED by the St. Louis Fed, and it shows the interest rates going up over time. This interest rate hike, so there may not be a big surprise today, and the market is not pricing a bunch in, but it does bring up the larger conversation about rising interest rates in an economy in a market that's at an all-time high. In 2016, we had our first rate hike, Matt, that we'd had in a decade. In 2017, we had 2 rate hikes. This is the third of presumably 4 this year. That rising chart shows interest rates rising over time. How long can the economy and the market stay strong while interest rates are rising? Matt, I'm going to throw that to you first.
2020.
A couple years, maybe?
Don't piss off the Fed.
Yeah.
2020.
Noah?
Well, I don't know about time. It just depends on, I think it's more about the actual rate itself. I think it's 3% to 4%. In the past, it's been 5 and 6%. Just due to the enormous debt bubble, I think that the rates will only have to be somewhere between 3 and 4% before we see a significant cool down.
And I want to talk about that very quickly. No, you're absolutely dead on there. You know what's a bearish downtrend, guys?
Wait,
bearish
did you say
downtrend.
dead wrong, or did you say dead on?
No, you were dead on. You were dead on.
I heard dead wrong too.
I heard dead wrong, and I was wait a minute. Fighting words.
No, dead on. But no, a lower low, lower high is a bearish downtrend, correct? Okay. Yeah. So if you look at the Fed and their interest rate hikes and decreases since 1998 until today, in 1998, they went from a 2% interest rate to a 6.5% interest rate at the top. Okay. Now, Noah, if you'll look at a S&P 500 chart on a monthly chart over the last, since 1998 on, in 1998 to 2000, it went from 2% to 6.5%. That caused the market to slow down, and eventually the market will have some type of event, economic event, or some black swan event that will finally just start crashing the market. And at the bottom, I believe they went to a 1% interest rate. Okay. So at the bottom in 2002, 2003, they went back down to a 1% interest rate to kind of stop that market over. Now, as that stopped the market, then you had the Housing Act of 2002, where we basically said, hey guys, listen, I don't care if you have any money, just everybody go buy a home, and then everybody go refinance a home, and everybody go take the money out of that home and go buy a boat with it so that we can create that debt bubble that Noah was talking about. And then in 2005, they start raising rates again, and they went from that 1% interest rate to about 5.5% at the top, and that starts driving the market, turning the market back down again. Then as it's crashing back down, 08, 09 area, at that point, they went to a 0% interest rate. So at the tops, you went from 6% down to 5%. In the bottoms, you went from 1% down to 0% interest rates. And then in 2015, we started slowly coming, in 2014, we started coming off quantitative easing through the QE tapering program. That lasted about, 18 months. We started gradually increasing interest rates. Like you said, Tim, we had 2 in 2017, 3 so far in 2018, most likely 4. You started at 0% interest rates. You're currently at 2% interest rates. Presumably today we will be at a 2.25% interest rate. Presumably in December, we're going to be at that 3% interest rate. And if you get another 4 interest rate hikes in 2019, ladies and gentlemen, you are right smack dab at 4% interest. And I want you to look at that trend again. It goes from 6 to 5 to 4. It goes from 1 to 0. What's it going to do next time? Well, next time, guys, there's only one answer. Everybody talks about the ammunition that the Fed has to stop bear markets. Next time, 0 interest rates doesn't get it done. Quantitative easing 4 doesn't get it done. You got to go negative next time.
If you had interest rate in your bingo chart, you probably just won bingo, is what I'm guessing. I just heard it about 12 times in a row. That's right. Interest rate hikes. I did see the Fed bingo thing Cody found. That was pretty clever.
Again, morning brew. Thumbs
up.
Very,
very, very good. Hey, listen, I don't know exactly when, but I don't fight the Fed. Obviously, they're raising very gradually with a purposeful intent. Obviously, 3% in the long term. Interest rates historically are still relatively reasonable and low, right?
2% is still low. 3% on the 10-year is still low, yes.
Yeah, of course it is. I mean, when our fathers bought their first homes in the 1970s and 80s, I'm guessing they probably paid 8 or 10 or 12 or 15% interest for the home.
in 1981, 82, you were paying 18 to 20% interest.
Yeah.
But
yeah.
this is a different world today than it was back then, right? I mean, you got
It's a different United States. Okay. Because even to buy a home in some of the third world countries, you're paying extraordinary interest. I mean, so the economy is a reflection of currency stability. I'm with you. Obviously, if they raise for a long period of time, we get to 2020, we're at 4 or 5%, that could be a problem. You can't fight these interest rate cycles forever.
At some point, the interest rate is going to have a massive impact on the marketplace at some point. We've seen that throughout history. We've seen that throughout the entire market cycle from 1913 to 1929 to 1936 to 1945, 46 to 1952 to 1960 to 1968 to 1971 to 1978 to 1982, in 1987 and in 1998 to 2000. We've seen this throughout the entire time frame that the Fed has been around since 1913. So this is going to have an impact on the market at some point, and I know they don't want to talk about, or they are risking hyperinflation in the United States, very similar to what we were experiencing in the 1970s that led to that 1980s radically adjustment of the interest rate policies as led by, I was going to say the great Alan Greenspan, but I'll say the infamous Alan Greenspan in that capacity. But, so I do believe this is going to have a net negative impact over time. But I'm not looking at today and saying, hey, listen, I'm going to get all freaked out today because we've known this event was going to happen for 6 months.
What's interesting as you're talking and I'm thinking, the reality is the Federal Reserve is not supposed to be in the asset price game. They're supposed to be in the interest rate, currency, and debt game. And so whether or not stock prices go down, I'm sure as long as they have an orderly retreat, usually an academic or a banker, Matt, is going to come out and say, well, asset prices may retract a little bit or whatever it is. They're going to use fancy lingo. Who knows what's going to happen to stock prices over the long haul? Right now, we're bullish. Let's break down each of the markets one at a time here, Noah. ES contract we've already looked at. Go on to the Dow. It's been very, very strong lately. I actually really like the pullback in industrials, Matt. One of the setups I saw consistently as I was doing my scanning this morning were on stocks like Cat, Deere, Boeing. Nice little 3 candle pullback. Same kind of thing you're seeing in the Dow. Matt, do you still have this ranked number 2?
I do.
Yeah.
I do. And shockingly, I mean, we looked at the Dow before we looked at anything else. That leads you to believe that the Dow is kind of on our minds. I was talking to one of my students, and she might be here. Linda might be here. She usually is. Linda, I see you out there. Welcome to the Halftime Crew. I was talking to Linda the other day, and we were talking about kind of how we go about kind of the subtleties we go about in the halftime report. And I said to her, well, you can really kind of see the rankings of what's on our mind with the indexes based on which one we look at first, right? And that's just kind of a subtle, like when you're looking at the Dow, that tells me before you even looked at the S&P, right? That tells me that you're getting pretty bullish on the Dow, bro.
I like the industrials right now. I mean, take a look at Boeing. It was on the options report, which is a huge industrial component, maybe the most important for me. Nice little pullback pivot. I like the long-term resistance that we might be breaking out of on some strength. Now, that's not a retracement setup for me, so I don't play that. I'd play the breakout up here. Noah,
it's a high base breakout.
Yeah.
Yeah. If you look at that, you're up against resistance. So you maybe even forming cup and handle, big cup, small handle.
Sure.
But breakout for sure.
And take a look at Caterpillar.
Before you look at that, look at the sector itself, XLI.
XLI, yeah.
XLI, look at this retracement inside candle formation on XLI happening right now. It's a beautiful technical setup happening on XLI.
I'll believe you as soon as my data catches up with me. That is a pretty setup. There is a textbook setup that gives me strong Pavlovian responses.
What do we call perfect retracement, Halftime Crew? We call it the Goldilocks retracement.
Yeah, and a trigger we're going to call Pavlov's bell, I guess.
Oh, I like the Pavlovian reference.
I'm already salivating. You can buy a lot of tacos if that goes up.
Tim's going all academic on us today.
Hey, it is what it is.
Just talk to Bobby. I know exactly what happened.
Let's move on from the Dow to the NASDAQ. And even though I have been cautious with tech, there are some areas of tech that I'm very, very excited about here today, Matt. I'm looking at some of the charts that I keep track of myself. Netflix is about to break out of a very significant price point. The NASDAQ just broke a little short-term range here. Now, you're not near the high yet. You're not at the high, I should say. But tech is looking very strong today as well.
I'm taking that as a breakout.
Yeah.
7,600 to me was important. And again, it might not have been important to everybody, but 7,600 to me was a fairly strong intraday resistance level over the last week. You're breaking out of that today. You're showing strength. You're up 0.5% on the day so far. You're up towards the highs. Yeah, I'm taking that as a positive.
No, if you had to buy one or the other, the Dow or the NASDAQ, and obviously you don't have to pick one, but I'm going to put this into a box here. Which one do you think is stronger, NASDAQ or the Dow?
Dow's pretty seasonally. My expectation is for the NASDAQ for tech. Tech does extremely well in the fourth quarter. So I kind of come in with a predetermined bias, unfortunately. But that's what I go. I think a strong breakout here leads a lot of price action upwards. So
sure. Moving on
I would need that advice as well. Noah is excellent at seasonality.
Well, and that predetermined bias is based on data and research and experience. So those are usually good biases to have.
I just have to recognize that it is just that. It's my bias based off of historical data. And one of the things about trading is you have to be willing to accept when your bias is wrong. You don't get caught up in that. But I do have a strong expectation for tech. And so I go, I don't just trade the index. I'll go cherry pick the candidates in there that you're already watching.
Sure.
So I think we're poised for a nice pop.
Last but not least, the RTY, which is small caps. And actually, small caps had shown a little bit of strength yesterday, a little bit weakness here today on a relative basis. They're down 2 points, but flat. Here's the thing with this chart. To me, it's much more complex than the other ones. The other ones are strong, and this one is more neutral, but yet still in a long-term uptrend. Old resistance, new support should be holding out here, and it is trying to fight that 1,700 level, Noah. And what would have to happen, and you tell me what you know from seasonality, for small caps to take off and run?
Well, they're typically going to go with the broader market, which also does relatively well. And I think this consolidation is the kind that can lead to an upward run. It's just a kind of a prolonged retracement into support. I would want to see a breakout above those candlesticks out there around 1730 or so. Just to really confirm that that's actually a multiple bottom coming up off that, because you do have a nice trend, and I think it's just wait and see. And it's not as volatile as the other indices, so you don't expect it to move as much. But when it does move, I think we got another good run up towards 1775.
Give me the dollar next. Obviously, on Fed Day, the currency markets are going to be in question. Matt, going into any kind of Fed announcement, directionally trading or day trading currency cross pairs is probably not something somebody should be doing unless they had a specific system or a reason, right?
I'm going to trade it.
Are you going into it or after it?
Oh, heavens no.
Yeah.
You don't touch currency. And let me be very clear here, ladies and gentlemen. You don't touch currency in front of a Fed announcement. That is asking. There's a Twitter handle I kind of enjoy. It just gives me a little bit of laughter on a daily basis, and it's called the Darwin Award, Tim. And if you buy a currency day trading in front of a Fed announcement, I'm going to nominate you for the Darwin Award. So, no, you don't touch currency before the event. You really don't even touch it immediately after the event. We've talked in the past quite a bit, but there's the initial movement and then there's the secondary movement. The secondary movement happens during when Jerome Powell's given his speech, about 30 minutes after the actual event. That's when you actually trade the currencies, when after the initial volatility slows down and you get a very clear trend start developing on the intraday chart. I would recommend a 15-minute chart on that. So no, I'm looking to trade not in front of the event, obviously, but after the event. And there's some pretty good setups out there, that I'm looking at. Obviously, I would come off that stance, but a potential short Australian dollar against the dollar and a potential euro dollar pair crossing perhaps above that $1.18 barrier. So if I get crazy movement against the dollar and the euro's appreciating against the dollar above 118, I think that's a pretty good buy signal.
No, this is a head and shoulders pattern that's about to break down, but yet we have a rising interest rate environment where in Japan they don't, and in Europe they don't, and in Britain they don't, and yet we are the ones raising interest rates. I would expect the dollar to rally It's not. In fact, that chart is as ugly as you can get on a breakdown. What's going on here?
Well, I think it's, from a question perspective, you got a correction into that 93 zone, and it looks bearish. It's below its moving averages. You have seen a lower high form, and you do spot that inverted head and shoulders pattern. I'm always one to say, well, let's back out and put it into perspective into a weekly time frame. And, on that weekly time frame, it's kind of just a little pullback off of a motive wave up that's establishing a reversal. So I wouldn't be surprised to see it rally out of here. The policy, I think, favors a stronger dollar. So it's kind of, again, we're comparing it against 5 other major currency pairs. But if we get rate hike, I see the dollar rallying out of this little weekly pullback. On the daily chart, it looks a lot more suspect.
Logic doesn't always win out. One of the most costly things that any trader could ever do is let their opinion drive their positions. I'm with you. I believe the dollar should strengthen on interest rates rising and with what the Fed is doing, but the market doesn't, and it's been selling it now for about a month and a half. This is going to be the one thing I watch the most here today, Matt, is the dollar and maybe even gold. Take a look at GC, because we've been stuck in this range, and it's significant to me. As soon as we get a break one way or the other, we are literally right in the middle again. I've had the range at 1190, 1220. So we're at 1200, but we've been anchored around this 1200 level for a long time. Matt, commodities can rally on a current on this move, right?
Oh, absolutely. A strong dollar move will strong dollar down, gold up. Strong dollar up, gold down. So if you get what you expect, Tim and Noah, you expect, dollar appreciation in a rising interest rate environment, that's going to negatively impact commodities.
And if you think about the Fed, even go back to the data you started with, Matt, stock prices are probably the one thing that isn't impacted the most directly. Federal Reserve interest rates will affect bond prices first, and then bond prices will affect commodities, currency, all those kind of things. Those parts of the market are going to be driven. Noah, I'm looking for a break one way or the other. Do you have a bias on this chart? It still looks bearish to me, in my opinion.
I think my bias is bearish. I think a rate hike strengthens the dollar. And again, this is one of those things where you trade what you see, not what you believe. But I do have a fundamental opinion based off of the policy. If they do strengthen the interest rate, I think the demand for gold drops. And if you look at it from like an international business perspective, which would you rather do? Hold gold that pays no interest, or hold a strengthening dollar that does pay some interest? And so, gold is a hedge, and I think people will be happy to own the currency that's paying a little interest.
Yeah, I agree with that. Move on to oil. Now, oil seasonally, Noah, I want to get your take on what happens with light sweet crude. I know that Brent crude has been a lot stronger than the light sweet crude recently, but the CL is what we always look at. Yeah. CL breaking out. And actually, Trump in front of the UN yesterday was talking about sanctions on Iran, Matt, that are going to hit in November, retracting some of the supply in the market. If we have a supply problem and demand stays constant, you would consider the price to go up. No, give me a seasonal read on this. Matt, give me a technical read on this. Let's break this down.
So I backed out to a monthly or a weekly chart with a lot of data and history on it. And the one thing you have to understand about oil seasonality is the data is extremely skewed from what happened in the second half of 2008 and what happened in the second half of 2013. You had these tremendous bear markets in oil that weight the seasonal data to show bearishness this time of year. But if you go back and you study the data, at the end of each year, just look at it from fourth quarter on, some years you have down, some years you have up. There's a kind of a mixed bag. You go back to like 04, 05, you see little downward moves in the market towards the end of the year, like you see in there. Let me get a slightly better color so you can see that better. But downward moves in the market at the end of the year, downward move in the market at the end of the year, consolidation at the end of the year, upward movement market at the end of the year, upward at the end of the year. Kind of half and half. And so I just have to keep in mind that seasonal data is skewed because of those two big drops at the end of the year. And right now the chart suggests bullishness, and I think it's going to come down to those inventories. Brent crude does a better job this time of year for whatever reason that gets used more in the formulations for cold weather. But it's, the chart back, just trade what you see. I think that the seasonal bias on oil is a little bit challenging to peg down because of that data skew.
Matt, from a chart perspective, we've talked about buying crude for a while. This is something that we've been hesitant to get on top of, though, because of some of the inconsistency on the breakout. Noah, you'll see those candle tails at the end of August and the beginning of September, where it was trying to break that 70 level and then would pull back. Higher pivot low, higher pivot low. Here we are on a breakout, Matt. Would you be waiting for a pullback into like the 71 zone, 70 zone? What are you looking for here?
Short term, I'd like to see a pullback down into the 70 zone, the breakout channel. That's typically the good way to go about that. That would come right back down into the rising 20-day moving average as well. So I don't think you can buy it at the highs here. It's showing the last 2 days, it's slowing its momentum at the highs. Look for it to come back down into 70 from a short term. And then you could definitely trade off that retracement, off the short term retracement down to 70 in the 20-day moving average. However, if you'll switch that out to a weekly chart here, Noah, I'm getting a little concerned, guys. If you look at just kind of over the course of 2017 coming into 2018, the second half of 2017 had rapid price increases. The beginning of 2018 from February through May had rapid price increase. But since then, you've done nothing but slow down. And now on that weekly chart, you can make an argument that you got a double bottom slowing momentum with the potential head and shoulders formation happening on that weekly chart. And so I'm a little concerned about it.
If anybody is really, really bad at forecasting, you should go apply for a job with the Energy Information Administration, because you'd be just as good as they are. They had
hold on. We gave them a golf clap. They were a couple million off last time. What were they off this time?
3 million. They had a small build-in supply instead of a draw that they had forecasted. They hardly ever get it right.
How do they get paid any money to put out their forecast? I could literally, hey guys, I could wake up on a random Wednesday every day and send you guys a text message saying this is what the inventory report is going to be, and I promise you I'm going to average closer than what they are, and I'd just make up the number.
And my fantasy football picks have been more accurate than that, so that's pretty good.
Well, I think
I don't know if we're going to talk about your fantasy football strategy on the halftime report here now.
Although Noah, you are going to lose this week.
Probably.
Are you playing with Cody?
Yeah, you're playing me.
All right, football on the weekend, markets during the week. Actually, football tomorrow night as well. And Noah, we talked yesterday on the halftime report about the yield curve. It is somewhat tightening, but not all the way inverted yet. We'll talk more about that if and when it does invert and starts moving. Moving on to some stocks that are in the news. Obviously, yesterday, Matt, we broke down the Nike earnings. I think we've got to revisit that one here today and talk about it. Basically, the consensus and the conclusion was, don't touch the earnings, wait for the gap. And if it gaps down, it's a buying opportunity. I got to tell you, I came in this morning, I saw your tweet, I saw Nike, and I'm like, boom, it's a buying opportunity.
That's all. It wasn't Nike, it was my tweet. Come on.
I'll give you credit.
All right. Good. I literally said last night, like right after Nike's earnings, it's about 4:30 Eastern Standard Time. And I said, okay, guys, the volatility's down. Okay, volatility's down. Price is down. It's gapping right down into that 20-day moving average. This is a buying opportunity. Tim, you executed that. You went long call kind of at the open here. I'm looking at an entry point right here today. I'm not in it yet. I kind of wish I was doing it a little earlier. I had a little bit of other meetings this morning, but I am looking at getting into it today. I think the gap down is a complete overreaction to what was a very positive earnings report. You beat on expectation, you beat on revenue, you came in line on revenue. The expectation on earnings per share was 0.62. It came in at 0.67. The revenues was about $9.9 billion in revenue. And yes, that to me was an overreaction. Gap down, great stock, gap down into a support zone. I think that's an easy call.
Well, we're going to go behind the curtain here a little bit. And this one is working so far, but it's very, very early in the trade. And for the halftime crew, I'm going to do you guys a real solid. I'll let you guys kind of tap into the mind of Tim here as a trader. I actually didn't do it right at the open map. My entry, I'm looking at my fill here, was at 8:12 in the morning, my time. No, I'll break that down into an intraday chart. Now, there's a couple of things I would give everybody out there some advice on. Number one, the opening of the market can be volatile and inconsistent. So give yourself some time, whether it's 30 minutes or an hour, whatever it is. Let the market settle in here a little bit. When Nike broke that intraday high there, Noah, I decided to go long call. Now, right here before the Fed, I will turn it into a bull call, even with that slight movement That's going to start my trade in the profitable position, but I don't really like holding a lot of long calls, Noah. Noah, rate the trade here.
I like it. I think it's a very good short-term technical play. I like the technical setup. I like the earnings. I also have an opinion, a bias on Nike prior to earnings. I think that their marketing play was genius. I think they know their demographic extremely well. And, you got a strong retail presence in the fourth quarter. So I had a bullish bias heading into the earnings announcement. In fact, I actually had a position on that I rode through it. But I like the play. I like the adjustment strategy too.
Now, it's easy.
Can I rate it?
Give me a rate.
Okay. Way too aggressive in front of a Fed meeting.
Yeah.
Not if he believes the Fed's going to be a non-starter.
Hold on. He just spent like the first 30 minutes trying to convince me about how volatile the Fed is. And then all of a sudden he's popping call options on Nike before the Fed. Come on.
Well, here's the thing. I mean, a long call position size the way I do, it's literally.
No, I know what you're doing. And it's a good strategy to roll it into the bull call spread in front of the Fed. I'll tell you right now, if the Fed was not here today, literally in 50 minutes from now, if the Fed wasn't here, this is an intraday retracement where you could also pop call options right now.
Yeah. Yeah.
Matt, you just made me think of a question. Would you rather put on a Nike trade before the Fed meeting or buy Tilray?
Let me get Tilray. Let me get Tilray chart.
Are you ready for that?
So would I rather get punched in the face?
Count for like a marijuana mention?
That's
for
the question.
Bingo.
Okay, I'd rather get punched in the face. Nike. I wouldn't have touched Tilray. I think that's great. Again, $10 billion market cap, and they're putting out press releases of $10 million in revenue. This is a joke stock. It's an absolutely joke stock, and it only happens in euphoric, crazy environments from people who don't understand trading and deserve to lose their money. So no, I would not rather do Tilray. I would rather do call options on Nike.
And a real quick shout out to Coach Emily, who was on our podcast. She just put in our chat here. Greetings from Emily and Jake, catching the halftime show at the airport. Good to see you guys out there. And by the way, hashtag halftime crew. Everybody out there, if you're watching our show, it's Fed meeting day. Give me a quick like and a share. And if you've attended our show in the past, I think you probably know Matt's take on pot stocks. They are not exactly on your radar right now, Matt. Here's the thing, though. Over time, they will become legitimate companies. There's no question.
I'm going to wait for everybody to lose their money, and then I'm going to buy after it gets tanked. That's what I'm going to do.
Going back to Nike, that's a beautiful trend, Noah. Obviously a gap down gives you an entry point on price. It is now moving up, but it's not exactly a technical trigger for most unless you can break it down to an intraday. Matt, you are right. It was an aggressive entry because I was below a gap point, on a earnings date where they did not react positively.
No, I'm Tim, let me rephrase. You are a professional at this.
I know.
You have done this for 13 years now. You have more trades under your belt than 99.5% of the entire population. Okay. I am perfectly fine with somebody of your skill set, your talent, your trade management ability, your reaction to events, going out there in front of an event, because you have a plan you're going to execute regardless if it goes up or down, regardless of what the Fed is going to do. Mm-hmm. What I don't want our listeners thinking is that they can do the same thing simply because a professional did it.
But here's, I guess, the reason why I bring up my specifics, and I rarely do, talk about the details in a trade I did. Yeah. I think it's a unique entry point that's not traditional. A lot of people don't play gaps and they don't play the post earnings for a lot of reasons. Nike's a huge company. It didn't gap down. It gapped down within the expectations of the MMM. Yeah. There's a very big difference between Nike dropping from 85 to 82 and if it went down to 78. Listen, I would not have played the same play at 78, by the way.
Tim, I said yesterday on Twitter I would do the exact same thing. I have no problem with the trade. I was just making a joke to my brother, and I also tried to, my subtle way of telling the halftime crew that, that's an advanced strategy that you should probably wait for the Fed until after.
Noah, is Nike still got an opportunity here? Let's say, obviously, a lot of people probably have not touched it yet.
As a swing trade, yeah, absolutely. It just comes down to your time frame. I mean, you use kind of a day trade entry for a small gap off of the earnings, but if you look at it in the bigger context, beautiful uptrend, nice big strong buy candle on above average volume. They did beat earnings, and again, I think it's a really nice swing trade setup. If I had just found this without earnings being in the equation, I'd be all over it.
Yeah,
the most likely scenario 2 weeks from now is the exact same thing that happened in the past 2 weeks after the Colin Kaepernick gap down. The most likely scenario is price appreciation on this. Noah, you said it best. Nike is a wonderful company. It's one of the bigger companies out there. They basically destroy their industry, and they understand their demographic more than anybody else. And they made a marketing decision that has been in the works for years now. Okay, years now. And so this is a company I trust. It's a company I like. And yes, I have no problem with anybody buying it. I just think it's a little bit more, I think the better approach to it is to wait till after the Fed announcement, and then you're going to see kind of back just to normal supply and demand.
Well, for the next 45 minutes, in fact, probably for the next hour and a half, the only thing that I would probably have anybody doing if I was sitting there mentoring or coaching them one-on-one is hedging, doing volatility trading, and planning, because you don't go into an event in 45 minutes and start popping trades into the market. I mean, this is time to plan and prep and even potentially hedge. Matt, I know there's not a lot of risk in the stock price movement, but you got to look at those risks and try to understand them. A lot of other companies in the market here that I want to, kind of start to break down. Give me a look at FCX on the Tackle 25. We've been talking about gold and silver for some time. Cody put this one in the prep as a Tackle 25 stock to keep an eye on. I love the company from a long-term perspective. It's got a little bit of a breakout potential forming here, Noah. No, at a break of 15, is that an entry point for a long-term kind of investment?
I see a forming head and shoulders on this. And one of the things I notice here, and I'll just grab a little drawing tool just to highlight it here, is this is what gives me the confidence to buy that breakout, is the size of this buy cycle, back in here where you have that nice little rise compared to the size of this buy cycle and strength and kind of movement. You're seeing a shift between selling to buying. And I think that little doji setup, I'd be a buyer above 15, no problem.
Also, Freeport has a lot of copper. So take a look at copper. It's /HG. So it's where Freeport's getting a lot of its turnaround, is that strength right there in copper.
Yeah, that's a great point, Cody. They do more copper than gold.
Interesting. I've wanted to see that company rally for a while, Matt. I don't have a current position on it. I think a break would be something I would even potentially add as a stock position.
It's a Tackle 25 stock. It's wonderful. It's fundamentally strong. It's got liquid options and a break above 15. I could definitely support anybody saying this is a long-term position for me to start doing cover calls on.
My number one stock I'm watching today, though, is Netflix, NFLX. I've been talking about this one for quite some time. This is a company that I've not had a lot of trades on. I don't in the last month or two, because after that earnings gap and I played it bearish for a little while, I really haven't touched it in August, in September. And now I'm looking at a potential breakout. Now, for me, a close above 380. And I would not do this in front of the Fed, but I love this chart. And there's many reasons I love the chart. The relationship of the pivot points. You have the gap down to 350 on the low pivot, then 330 on the pivot in July, 315 or 310 in the middle of August. Guys, break this chart down for me. Matt, I'm going to go to you first and interpret Netflix for me.
Short-term consolidation pattern. You got a little bit of a rising wedge between 350 and 375. I like the call of the break of 380 here, Tim. That's kind of where that gap range kind of started here. I mean, this is something that not Nike, but Netflix is something that we've talked in that scouting report meeting on Fridays for the last couple of weeks. And I think all of us coaches over there at Tackler we got a hair trigger on this one. We're just kind of waiting for it. I love the breakout candidate here. And this is a stock that does have a tendency to break and run, right? It has that type of leg in it to break and then run, continue to run out. the breakout's not overextended. You don't have any type of quick price appreciation coming into the breakout. It looks like a clean breakout. I agree with the close above 380. And for me, that would be an easy bull call spread.
Noah?
You mentioned hair trigger. I already pulled it.
Yeah, that's why it's there. Try. I don't blame it.
Well, that does actually get to the question I was going to ask you guys, because you could debate where the trigger is here. You had resistance in August and September about 375-ish, right? And tails in there, Matt, that had you could have debated that this already triggered.
375, 376 is the resistance area. The one thing and the kind of the thing that we kind of are a little hesitant on that breakout. I love the trade by Noah, by the way. I think that's it's aggressive, but it's wonderfully done.
Let me restate it. I have an aggressive trigger. I pulled the trigger already like a couple weeks ago.
Yeah.
About a week and a half ago. But I did a broken wing butterfly, which had a really relatively low delta.
Yeah.
And I took it as a seasonal play, like clear through the end of the year. So I'm already pulled the trigger on that, but this is not an aggressive position. It was just a anticipation.
It's a conservative trade off an aggressive kind of
aggressive chart.
Yeah, exactly. Yeah. Exactly. No, I love it. It was good play.
I take the conservative side. My trigger is not until after it breaks 380. So I'm being more conservative on this. I want a stronger break, and that's what I'm looking at.
Either way, I do think it's breaking out today. My point is that 380 barrier comes from where it gapped on its earnings. It's like 380 by 382. And so that kind of gap, if it breaks out of that, we can expect quick price appreciation to close the gap to 400. Wouldn't you agree, Tim?
Yeah. When Noah said broken wing butterfly, my brain instantly went into build mode, and I got to know exactly what you did on this now, Noah.
Well, let's go. Let's just go click on some.
There you go. That's an example of the trade right there. And this is my virtual account, but I just created a out of the money broken wing butterfly, by 385 by 390. But the key is check out how low my net delta is. My net delta is only 9.9. So I'm not really super aggressive on the entry. I'm just expecting an extended run up, and I'm already in theta positive territory on the trade, and I do have a capped gain. That's the trade-off for that trade. It's not a very aggressive directional trade. It gives me the bias, but the day-to-day price movements don't. I mean, these are good through December. The day-to-day price movement doesn't really change much because I only have a delta of 9.9.
Yeah. Well, and also the one at expiration risk graph, I don't really think paints the picture on that either. Sometimes I think that risk profiles, and obviously if you're new, you got to look at the picture and you got to keep it simple. I like the one at expiration because it's the one painted in the book. But actually, what I love about that trade, Noah, positive theta, positive delta as well, with a debit cost and a limited price. I think that's fantastic. That's the kind of thing maybe we could feature in an upcoming cash flow club here, Noah.
I've got more than just featuring it in a cash flow club. My intention is to actually develop an entire system for everybody, because I think it's a really fun way to trade. It allows you to trade directionally without being too aggressive and to not overexpose yourself to risk.
I love it.
It's not often you get positive theta with a slight positive delta bias. I mean, there's ways to do it, but it's a conservative way against an aggressive chart. It's a wonderful trade.
I love it. All right, Matt, give me a stock that you're focusing on today. Give me a stock of the day.
I got a couple. Okay. The first one I want to look at is BAH. I found it today. Don't know much about the company. I found it today in a scan.
What was the symbol? Repeat that one more time.
Bravo Alpha Hormel, because that's my
next one. All right, pretty chart. Yep.
Okay, so the reason I like it is I like the name Booz Allen Hamilton. That's why I like it. It has nothing to do with the actual chart itself, but actually love the increasing momentum, love the slowing momentum off the retracement, triggering today, kissed off $50, which is a significant whole number. There was a lot to like about this. Again, I don't know anything about this company other than I found it on a scan, and it was just really, really setting up well. You do have one slight problem in the fact that you don't have liquid weekly options on it, but you still can do it. So that's what I'm looking at. HRL is another one I'm looking at. Company I like here, Hormel Foods, in the staples sector. Retracement slowing down really has, and the reason I like this one so much is, and this one's not triggering today. This would be like a trigger tomorrow, the next day or whatnot. But the reason I like this is because when you can pick something up immediately off a support bounce and you put a stop loss right under support, I love these types of trades because you got little risk from entry to stop with a potential pretty big return on a directional play there. For me on HRL, the stop loss would obviously have to be underneath 30. I would say 39.25. I'd say the stop loss has to be underneath that level. Hair trigger would be above $40 or getting above the 20-day moving average. So either one of those, if you're aggressive above 40, if you're conservative above the 20-day moving average type thing. But I like that one as well. Liquid options, you can play the stock. A couple on the downside here, Tim. We've talked recently about both of these. WHR.
Yeah, I like this one a lot. Actually.
WHR, little breakdown out of a descending
You're
triangle.
gonna steal my pick now, aren't you?
Yes, I am going to steal your
You're stealing my pick and just gonna go for it.
Your pick. That's my pick.
It was on the paper.
First of all, the three of you took it from my option report on the weekend.
We did take it from the option report. That is true, Tim.
Cody is trying to take credit for me plagiarizing him when he plagiarized Tim. Cody, you just called yourself out. You see that?
Hey! I was gonna give credit. I was gonna cite my sources. I'm a scientist. I know how to do that.
Okay. Another one, Weibo WB on the downside as well.
I really like this one. This one is going to be sensitive to whatever's happening with the Chinese and emerging markets. Obviously, they all those patterns and all those charts look in some ways similar, but from a relative weakness standpoint, I think WB has one of the cleaner charts. Baba has more opinions about it. If you were going to pick one or the other, I actually like WB, but a little bit better.
I was trying to type in WB, but it wound up in the chat. So that's what happened there.
I gotcha. So it is a big play on China. Okay. I mean, you could make a case.
Baba then, okay, because I'm in Baba, and basically I've been losing a little bit of money.
Yeah, me too.
I'm losing a little bit of money based on theta. I mean, are we just going to say we're out on this? Is it?
I'm not out unless it closes above 170. I have a trading plan. That was my original trading plan.
That's where my stop's there too.
Yeah. And the reality is some of the most difficult decisions in trading are the impatience that you can feel when something is just not developing. And it doesn't look like a lot of candlesticks, but psychologically, and everybody out there in the halftime crew, you guys are vets. You guys are awesome. You know this. 10 days in the market can feel like 10 years sometimes, because you're waiting on churn to kind of develop and then kick through. But no, this is why, like when you're teaching students, you always focus on trading plan and taking emotion out, right?
Yeah, absolutely. And I think that in my experience, the best thing I can do as a trader is to take myself out of the equation by having the trades automated, having the decision points automated. So both you said, I don't have an exit until 170. Well, that means that you're not overly, reacting to those little two candles up. You're not sweating out the little, oscillations of the price. You have a plan.
No, it has to go right now down.
But now, well, yeah. I think that's the whole point, is to plan the trade. Otherwise, your emotions and your impatience do get you.
I've been telling the lounge this for about a week now since we've been talking about this trade. People keep asking, what about Baba? What about Baba? What about Baba? I've been telling the loungers, I'm like, my stop's at 170 and 30 cents.
Yeah, that's what
it right above
170. Yeah,
it hasn't touched it, and I'm like, I'm still in it. My bias hasn't changed. The overall trend is down. Still in the trade. Don't freak out. Plan your trade. Trade your plan.
We could all become the chart whisperer and start yelling at the chart. It might listen.
Like Jerry Maguire.
Oh yeah, I used to yell at my charts all the time. I had to actually, when I heard my oldest daughter say her first swear. And it was the exact same words I was using in my trading room. I knew I had to get a door to close that so she couldn't hear me as much. I didn't change my behavioral pattern. I still yelled at my charts. I don't yell at them anymore. I don't have any emotions around the trades.
Large cap Chinese tech has been weak. I mean, you could make a case, Matt, that you should pull out a Baba and just put it in FXI. I mean, you could have an argument about that just because generally that is the overall index ETF.
FXI is showing short-term neutrality. It's up near resistance levels. If FXI breaks out of $44, I mean, I do believe you're going to see quick price appreciation in those markets.
I don't believe in everything, but I believe in support and resistance. So I'm going to play that until it breaks and changes and whatnot. If it breaks above 44, I'm sure Baba's breaking 170.
I
Those
love that
things,
quote, Jim.
those
I don't
things,
believe in everything, but I believe in support.
I believe in support and resistance. There's no
Get it,
doubt
hey,
about
Cody,
it.
get a meme, get it on Twitter for that. Come on.
Is that the tweet of the day? I like it. And a couple other stocks. There was an IPO today that I was interested in, and I got to find the symbol. Did you guys see this Survey Monkey IPO?
Oh, I know.
SVMK.
Yesterday, last week I was looking at the expected IPOs, and that was the only one that caught my attention.
What was it?
SVMK is what I had.
Well, I got one candle and it disappeared, so I got nothing.
Yeah,
I'm not getting anything either.
It's the first day of trade. I'm sure. I'm looking at my chart on this side right now. It's up $6 since the open. Maybe an intraday chart.
SVM is in Mac, K is in kite.
That's what I got on my chart. This first day I'm looking at the chart. Let me double check and confirm the symbol here.
No, something popped up. It just disappears on me because it's like SVMK. A chart pops up and then it says invalid symbol. So maybe it's just because I'm on a virtual account, but.
Survey Monkey stock symbol, SVMK.
Mm-hmm.
Yeah.
What are you trading IPOs for, Tim?
I don't trade them. It amazes me that a survey company can come out and be listed as a $3 billion company.
Welcome to Tech 2.
I remember stories, and this market has so much complexity in it because it reminds me in many, many ways of late 1990s market. I remember stories when I started trading in 2005 of, we knew the market was going to crash when they started having walkyourdog.com valued at this IPO price or whatever it was. And I will just put this disclaimer out there. We've got a Fed meeting here today with rising interest rates, and I'm short-term bullish in the market, but Matt, I still am a late-stage bull. Some of the IPOs that I'm seeing in tech and with these companies, Matt, and it's the pot stocks as well. It's Bitcoin last year. We are seeing some weird activity that I think historically we're
people who missed out on the last 9 years of record gains come into the market at the top of the market saying, let's go play catch up real quick.
Yeah.
And they're going to get their asses handed to them.
Well, okay, Sarah, Sarah. And that's the new phrase of the day. I'm making that the phrase of the week here.
I know. Yeah, c'est la vie. We were all getting so used to c'est la vie. And then all of a sudden Tim says Sarah, Sarah. And I'm like, what are you doing? That's like your catchphrase these days.
Okay, Sarah, Sarah. It's going to be a new one. I got to change. You guys started taking my other phrase. I'm going to make a change here.
No, we started making fun of you about that phrase.
28 minutes. Do I seem like the type of person that cares if you make fun of me or not?
No.
I mean, come on.
No.
Noah, 28 minutes until the announcement. Last thoughts for our team out there, halftime crew?
Oh, boy, great question. And those last time thoughts always get me. But I think my big takeaway from our conversation today is the idea of trading the plan. Have your plan in place, trade the plan. Of course, be aware of the Fed and everything else, but plan your trades before you place them and stick with the plan. Matt,
give me a final thought here.
Just everybody get excited to play bingo drinking games.
Yeah,
I think it's gonna be 0.25. I think it's gonna be a lot of noise, not a lot of movements. I'm gonna go with the statistical averages. I think it's bullish. I think the movement is bullish. Obviously, I'm not touching it in front of that, but that is my bias going into it. I don't think the speech Jerome Powell gives tomorrow is going to be crazy, and I don't think they're going to go in attack mode against the president. I think they're going to state that the economy is strong, that they're on pace with their inflationary targets, that that the labor market is doing very, very, very well, and it will justify their long-term vision of rising interest rates in December as well as 3 to 4 next year. I think it's going to be par for the course today.
Well, and my last thought is tonight I'll be doing a webinar here, guys. And for those of you who already are trading the cash flow condor system, this webinar is to promote it. So you're more than welcome to come, but it's really for people who don't have it yet or don't know what it is. I just put the link in the chat, Get Condors. It's a webinar registration page. That will be at 6:30 Mountain Time. And really this whole thing with that cash flow system and the conversation we're having here today, guys, you got to have a trading business. You got to have a trading system. No, I think you're right. The thought of the day probably is trade your plan. Matt, you talked about where your triggers were. You talked about where your entries were on every one of these stocks. I know we always have emotion, but when you have good money management, good design, and you approach it like a professional, you're much more likely to achieve success. There's no doubt.
Can I say something to that real quick, Tim? One thing that you have to understand, and the people, halftime crew and team tackle and all that, you guys get this. Tackle doesn't teach strategy, right? Mm-hmm. We don't do that. We teach system. And there is a vast difference between strategy and system. Strategy is you buy a stock, you sell a call against it. Here's the risk graph. It's called the covered call. System is you buy XYZ stocks out of this list. You have you buy, this is your position size rule. This is your risk rule. This is where you place stop losses. This is the expiration date you're going to sell the call in. This is the delta you're going to sell the call in. If the strike price ever goes up above the strike price, you're going to manage it this way. If the stock ever starts going down or stays sideways, you're going to manage net liquidation value. And, you know, our halftime crew and team tackle knows that. They understand the difference in strategy versus system. Everybody else teaches strategy. We teach system. That's the difference. Cash flow condors is a premium system at Tackle Trading that we've now been trading for since 2015. Okay. Mm-hmm. And since 2015, there have been 3 situations since 2015 where cash flow condors did not pay out in that month. Okay. 3 months out of the last 36 months. This system has an 85 to 90% probability of cash flowing between 8 and 12% expected returns. With drawdown, the average is 5 to 6% every single month, compounded. And if that doesn't get you excited, and if that doesn't get your blood pumping, okay, I don't know what will do. We could go be like everybody else in society today and be like, hey, let's go buy some pot stocks and I'll get rich quick. I've said this before. I'll say it again. We are the tortoise. We are going to get there. We're all going to get rich through compounding gains. And guys, think about compounding gains 5% every single month for the next 10 years. Think about how big of a number that goes into. And even if you're already a member of the halftime crew and you're already a member of Tackle Pro and you already have access to cash flow condors, all of our legacy students over there at Tackle Trading have access to cash flow condors. So if you're a legacy student and you haven't been using cash flow condors, you have access to cash flow condors. So let us know by emailing team at Tackle Trading and we'll get you all set up if you're a legacy student. If you're a non-legacy student, you have access to become a part of this amazing cash flow system. And it's not just the system. It's not just the videos. It's the mastermind groups. It's the blogs. It's the help. It's the support. It's the community. It's everything that goes into this. And that's how we change people's lives. Tackle Trading is about one thing. It's about educating the masses and making sure that great content, great community, great systems are available to the masses. And that's what we're going to do. And we're going to continue to do it. And if you want to be a part of that, then you have that opportunity.
Well, everybody's here to make more money and to change their life. I think that's why we are #halftime crew. Guys, give me one quick last #halftime crew, a like and a share if you have not yet. Great job, Noah. Great job, Matt. Cody, I need another player in fantasy football. Let's start talk trade after the bell here. We'll see you guys tomorrow for the halftime crew. And until then,
just an update on my 3 fantasy teams. I'm 1-8 so far this year.
Yeah. Strength in numbers there, Matt. The more teams you picked, the worse
the probability.
It was not great. That's all right. It's all for fun. Fantasy football should be just enjoyable. Even if you lose, it's c'est la vie. Okay, Sarah.
There we go.
We're moving on. All right. Well, we're done here, guys. Thanks for being here. We'll see you tomorrow.